This woman asked me, she says, I see your podcast, and she was asking me some questions. And then I asked her a question and said, where is your money? And what bank is it being held in? And she froze. Why? Is the bank not safe?
The trust and confidence we once placed in banks, viewing them as unshakable pillars of the financial world, have been significantly eroded. Robert Kiyosaki's insights serve as a timely reminder, urging us to delve deeper into the intricacies of the financial realm to better protect our assets and interests. In the contemporary financial landscape, we're witnessing a concerning trend. Esteemed banking institutions such as Silvergate, Silicon Valley Bank, Signature Bank, and Credit Suisse are showing signs of vulnerability. The rapid and unexpected declines are not only alarming, but also surpass the pace at which institutions crumbled during the 2008 financial crisis. These events bring to the forefront several systematic issues plaguing the financial sector. The unchecked power of governments to print money without substantial backing, the volatility of interest rates, and the risky behavior of banks lending beyond their means are all contributing factors to this instability. The unfolding scenario of successive banks facing challenges paints a clear picture. Our banking system, once deemed robust and reliable, is now on shaky ground. It's imperative for individuals and businesses alike to be vigilant, informed, and proactive in navigating this uncertain financial terrain.
And the 5 or 6 massive behemoth commercial banks like Wells, like JP Morgan, like Goldman Sachs, like Citibank, like Bank of America. These large, too big to fail commercial banks are more or less being backstopped and guaranteed by the Federal Reserve. Well, the rest of the banks, as we were told by Janet Yellen, if they're not too systemically large, as the majority of them are not, they won't be bailed out. They'll be bailed in, where the depositors are general creditors of the bank, and the money that you deposit really belongs to the bank and not to you. You are a creditor of the bank.
Our financial system, once perceived as robust, is now revealing its inherent vulnerabilities. At the core of this issue is the fact that our money, rather than being tied to tangible assets or commodities, is primarily anchored by the government's assurance. This reliance on mere promises have become even more concerning with the recent policy shifts. Instruments like the Bank Term Funding Program and the relaxation of the FDIC insurance guidelines have raised eyebrows. These changes suggest a growing governmental intervention in our financial systems, which many view with skepticism. By diluting the protective measures that were in place, we're potentially setting the stage for another significant financial upheaval. But the repercussions of these shifts aren't limited to the financial elites or banking professionals. The average person feels the ripple effects. As the government resorts to printing more money, the value of our currency could diminish, leading to inflated prices for everyday goods and services. This inflationary trend directly impacts household budgets, making it harder for families to make ends meet. Recalling the 2008 financial crisis, it was primarily driven by irresponsible mortgage lending. Today, however, the challenges are multifaceted. Smaller banks in particular are finding themselves in precarious positions. Their practice of long-term lending, combined with a lack of liquidity during challenging periods, has created a volatile environment. When faced with uncertainties, people naturally react by withdrawing their savings, further exacerbating the bank's instability. This current state of fragility in the banking sector serves as a stark reminder of its inherent risks, amplifying the significance of Robert Kiyosaki's advice. His insistence on the need for a comprehensive understanding of financial systems is not just academic. It's a survival tool in these turbulent times. Kiyosaki's message is clear. We must arm ourselves with knowledge. By understanding the nuances of economic downturns and the potential fallout, we can better prepare and protect our assets from drastic scenarios, such as banks resorting to seizing personal savings during extreme crisis.
But these other banks, if they go under, you will be bailed in, which means all of the depositors' money goes into the kitty to bail in the poor decisions and investments of those banks, and anything left over then gets given back out in a pro rata fashion, along with shares of what is a defunct bank.
Point 2. In the midst of prevailing financial discussions, Robert Kiyosaki emerges as a distinct voice, offering a unique and enlightening perspective. Unlike many who tread the well-worn paths of traditional financial advice, Kiyosaki ventures into uncharted territories. Central to his argument is the role of the U.S. Central Bank, commonly known as the Federal Reserve. While many view this institution as a stabilizing force, Kiyosaki identifies it as both a contributor to current financial challenges and, paradoxically, a potential key to their resolution. But Kiyosaki doesn't stop there. He expresses deep concerns about the erratic behavior of the bond market, emphasizing its potential repercussions on retirement savings and pension plans. In a world where many financial experts offer reassurances, Kiyosaki stands apart, casting a skeptical eye and urging caution. He foresees a looming financial storm, hinting at a significant market crash and ensuing chaos. Yet, amidst these warnings, Kiyosaki also offers hope. He challenges us to break free from traditional financial paradigms and to embrace innovative strategies. By doing so, he suggests that we can navigate the turbulent financial waters and discover new avenues to prosperity. In essence, Kiyosaki's insights are not just critiques, but also a roadmap, guiding us towards a future of informed decisions, financial resilience, and ultimately, economic freedom. As we delve deeper into his teachings in subsequent points, it becomes evident that his approach is both revolutionary and invaluable. Point 3. The widening gap between the wealthy and the average individual has profound implications, especially during financial downturns. Currently, the banking sector is grappling with its most significant challenges since the 2007 to 2008 financial meltdown. The core issue: banks are incurring massive losses from government bonds, largely due to aggressive hikes in interest rates. It's alarming to think that these bonds, traditionally viewed as secure investments, are now sources of significant financial drain. Such losses render many banks unstable, raising the question, why should the average person be concerned? The answer lies in the interconnectedness of wealth. A vast disparity exists between the affluent and the majority. However, an intriguing shift has been observed. From 2021 to 2022, the wealth of the bottom 20% of households saw a slight uptick, while the richest experienced a decline. This is unexpected given that the top 1% typically amass vast wealth, while those at the lower end have historically held a minuscule share. Even with this recent increase, the wealth of the less affluent remains dwarfed by that of the wealthy. Real estate plays a pivotal role in this wealth dynamic. Beyond mere home ownership, it's a crucial asset that significantly influences one's financial standing. A decline in property values can lead to a perceived reduction in wealth, prompting individuals to curtail spending. This, in turn, can trigger a domino effect on the broader economy. Furthermore, the health of banks directly impacts employment opportunities. If banks, due to their own financial struggles, become hesitant to grant loans, both individuals and businesses face challenges in securing financial assistance. This reluctance to lend can stifle business growth, potentially leading to job cuts. Conversely, when banks are in a position to lend freely, businesses can thrive, expand, and create more job opportunities. Point 4. Diving deeper, it's essential to understand the symbiotic relationship between banks and governments. Typically, governments rely on banks to fund infrastructure projects and provide public services. However, when banks face financial challenges, their willingness to lend can diminish. This hesitation can result in higher borrowing costs for governments, making it more expensive for them to secure the necessary funds.
If your money is in a bank, like Bank of Hawaii is one of those regional banks.
Right.
And Hawaii is a big bank. What's the Pacific Western banks? And these are regional banks. So if your money is in there, that means your savings then goes to bail out the bank, not the taxpayer. Am I correct on that?
That's exactly correct. That is exactly correct. You bail in instead of bail out. It's what happened in Cyprus. It's more or less the exact same thing that would happen in bankruptcy proceedings, where the money is used instead of making certain people whole, the money is used to make everyone whole in a pro rata fashion.
When governments are burdened with higher borrowing costs, they often face tough decisions. Essential services such as healthcare, education, and public transportation might see budget cuts, directly impacting the daily lives of citizens. In such scenarios, central banks can offer a potential solution by purchasing government bonds, providing a financial cushion. However, this intervention is a double-edged sword. Pumping more money into the system can lead to inflation, where the value of money decreases and prices of goods and services rise. This inflationary trend can strain household budgets, making everyday items more expensive and potentially out of reach for many. To counteract runaway inflation, central banks might consider raising interest rates. While this can help stabilize the economy and curb inflation, it also has its set of challenges. Higher interest rates can deter borrowing, making it more expensive for individuals to take out loans for homes, cars, or other significant expenses. For businesses, this can mean reduced expansion opportunities, potentially leading to stagnation or even job cuts. Balancing these economic factors is akin to walking a tightrope. Governments and central banks must constantly adjust their strategies, aiming to ensure the stability of the banking sector, foster economic growth, and protect the well-being of their citizens. Reducing interest rates might seem like an attractive solution, but it could invite inflationary pressures, necessitating a delicate balancing act. Furthermore, amidst these macroeconomic maneuvers, the persistent issue of wealth disparity cannot be ignored. The economic repercussions of any crisis are felt differently across various socioeconomic strata. The wealth might have buffers to shield them, while the middle and lower classes might face more immediate and severe impacts. This disparity underscores the importance of equitable economic policies that ensure all segments of society are protected and can thrive. Point 5. As the financial landscape becomes increasingly unpredictable, with major banks faltering, many are left seeking answers. While some attribute the instability to poor management or questionable decisions at the helm, Robert Kiyosaki offers an alternative viewpoint. In his dialogue with Fox Business, he zeroes in on the US Central Bank, suggesting that they are not just contributors to the current predicament, but also hold the key to potential remedies. The precarious state of the bond market is especially alarming. These bonds, often considered safe havens for investments like retirement funds and pensions, are now under threat. Despite reassurances from financial institutions about the safety of our deposits, Kiyosaki cautions that the worst of the financial upheaval might still be on the horizon. Navigating the storm requires more than just hope. It demands strategy. Kiyosaki, with his wealth of financial knowledge, proposes a twofold approach. Embrace precious metals. Gold and silver, in which Kiyosaki view, stand as bastions against the volatile financial tides. Unlike fiat currencies, which governments can print in abundance, these metals have intrinsic value and limited supply. They offer a hedge against inflation and the unpredictability of global markets. Investing in them can provide a safety net, ensuring one's wealth remains relatively insulated from broader economic downturns. Skepticism towards conventional measures. While central banks and governments might employ tactics like adjusting interest rates to stabilize the economy, Kiyosaki remains unconvinced of their long-term efficacy. He believes that such measures might offer temporary relief but fail to address the root causes of financial instability. In essence, Kiyosaki's insights underscore the importance of proactive financial planning. In an era of uncertainty, relying solely on traditional financial instruments and banking assurances might not suffice. Diversifying one's portfolio, considering alternative assets like precious metals, and staying informed about global economic trends becomes paramount for financial security.
Like that is, I've been on your program for years. So this here is a Kennedy half dollar, 1964. It's worth $10 today because it was pure silver back then. And also in 64, this went from a silver certificate to a Federal Reserve note. And most people don't know what that means. It means they're going to print as much as they like to pay your bills. That'd be like you paying your bills.
Pay attention to this. Both the Federal Reserve and the FDIC are hinting at the onset of hyperinflation, further elevating the value of gold and silver. Kiyosaki, holding up a dollar bill, emphasizes the government's propensity to keep printing with the terms counterfeit money. But here's an interesting tidbit. Among precious metals, silver holds a special place in his heart. He champions it not just for its intrinsic value, but also its industrial use, particularly in weaponry. For instance, every Tomahawk missile contains about 30 pounds of silver, so every missile launch effectively reduces the global silver supply. Switching gears to the digital realm, Kiyosaki dubs Bitcoin as the modern gold. While he retains his affinity for traditional gold, he's also keenly observing the cryptocurrency landscape. He even dropped a hint in a tweet, suggesting investments in GSBC, an acronym for gold, silver, and Bitcoin. It's worth noting that Bitcoin experienced a tumultuous journey, plummeting by 60% in 2022, only to rebound impressively with a 72% surge in 2023. For those looking to dive into the Bitcoin world, it's more accessible than ever. However, a word of caution, be wary of hefty transaction fees in some exchanges, which can sometimes reach 4%. It's essential to find a platform that offers reasonable fees. In summary, Kiyosaki offers valuable insights to help you maneuver the intricate world of finance. With this emphasis on both precious metals and Bitcoin, he provides a roadmap to optimize your investments and make your money work more efficiently for you. Point 6. When we immerse ourselves in the financial philosophies of Robert Kiyosaki, we encounter a blend of traditional wisdom and innovative strategies. Kiyosaki, while appreciating certain aspects of the stock market, often diverges from the typical investment enthusiast path. His perspective on traditional banking is particularly intriguing. He recognizes their foundational role in the financial ecosystem, but also highlights the challenges they face in an era dominated by rapid technological advancements and the burgeoning world of cryptocurrencies. Traditional banks with their brick-and-mortar establishments have long been seen as pillars of financial stability, especially with a safety net provided by the FDIC. However, recent events have exposed some chinks in their armor. This backdrop sets the stage for Kiyosaki's introduction of the infinite banking concept, a paradigm shift in how we perceive banking. To understand this better, let's first dissect the workings of conventional banks. They operate on the principle of fractional reserve banking. In simple terms, they hold on to just a portion of the deposits made with customers, lending out the majority. While the system has worked for centuries, it's susceptible to crisis, especially when a significant number of depositors simultaneously demand their money. Enter the world of infinite banking. Imagine a scenario where you're not just a vendor but also a financier. Picture running a lemonade stand, selling lemonade, and simultaneously offering loans to customers to buy your product. This dual role amplifies your profit potential, mirroring the way banks amplify their earnings. Infinite banking takes this concept and personalizes it. By utilizing specific life insurance policies, individuals can create their own financial reservoir. These aren't just static pools of money but dynamic reserves that can be borrowed against when needed, acting like a personal bank. But what truly distinguishes infinite banking from traditional banking is its robust security framework. While banks with FDIC insurance offer a commendable level of protection, infinite banking goes a step further. It leverages the stringent reserve requirements of insurance companies, ensuring a higher degree of safety for your funds. Consider starting with an investment of $100,000 in such a policy. This not only establishes your personal financial hub, but also over time accrues value, offering both liquidity and growth. In essence, Kiyosaki's infinite banking concept challenges us to rethink our financial strategies. In a world of economic uncertainties, it offers a beacon guiding us towards greater financial autonomy and security.
Anyway, with interest rates dropping so low, that's why people are kind of jumping into real estate because it makes it affordable. But when they drop interest rates, prices go up. And so today, if you talk to most people, we're in a bubble. And that's the dangerous part because I'm not saying they will, if they raise interest rates, the bubble busts. And that's why I'm talking about liquidity. Liquidity is how fast can you sell it. For example, if I buy a new pair of, let's say, shoes, and I pay $100 for the shoes, how long will it take me to sell those pair of shoes? It will take me a while because nobody wants them.
Here's the blueprint. Invest in a specialized insurance policy that amplifies your wealth over time. As you contribute, your funds flourish, and whenever you're in need, your reservoir is ready for withdrawal. Think of it as a covert savings hub, independent of traditional banking systems. Kiyosaki's insight serves as an urgent reminder that sticking to outdated financial strategies might leave us vulnerable. Grasping the nuances of modern finance and establishing a robust foundation is imperative. Drawing from historical financial lessons and looking towards the future, we're encouraged to navigate our financial journey with foresight and wisdom. As we conclude, embrace the empowerment that comes from financial literacy, proactive preparation, and strategic planning. Now it's your turn. If you found value in these revelations, give us a thumbs up. Craving more monetary insights? Subscribe and stay updated. To ensure you're always in the know, activate the notification bell. Share this knowledge with loved ones because making informed financial choices is a collective endeavor. We're curious, which financial strategies resonate with you? Your insights pave our path forward. Share your thoughts in the comments and let's continue this enlightening dialogue.